Welcome to today's Explainer. We are jumping right into a highly provocative concept today from a piece by Nexus Wealth called The Secret War on the Middle Class. Now, this material makes a really bold claim. It argues that the modern economic system isn't just going through a rough patch right now, but is actually intentionally designed to shrink the middle class. So we're going to impartially break down this hidden machinery they claim is constantly at work, and more importantly, look at what they say everyday people can actually do to step out of it. Let's dive in. Right out of the gate, the source text hits us with this intense assertion to frame its whole argument. You were never meant to get rich. Not by accident, by design. The script uses this idea to explain why it feels like your paycheck is quietly losing its buying power every single month, and why every dollar you manage to save just seems to slowly evaporate. It argues that, hey, this isn't just about personal financial mismanagement. According to this source, there is a literal, systemic machine behind this, operating 24/7 to keep you exactly where you are. So who's running this machine? Well, the script points the finger directly at the Federal Reserve. It really zeroes in on the central bank's control over the money supply and interest rates. The material fiercely argues that the Fed absolutely does not work for you, and honestly never did. It claims that every time the central bank prints more money, your hard-earned dollar buys a little bit less. And it insists that this isn't just some accidental side effect of a complicated economy, but rather the actual intended strategy. Just to really emphasize the sheer scale of this, the text highlights a massive, honestly hard to comprehend figure. Since 2008, the Federal Reserve has printed over $9 trillion. Think about that for a second. But the source asks a really critical follow-up question that we all need to think about. Where exactly did all that new money go? Because, as the script is very quick to point out, it sure didn't go directly into the bank accounts of average households. The source paints a pretty stark picture of where all that cash actually lands. It argues that this newly printed money completely bypasses average workers, flowing like a river straight to Wall Street banks, massive corporations, and people who already hold major assets. These wealthy entities get to use that cheap, newly printed money to scoop up real assets, like real estate and businesses, while prices are still relatively low. Then, when inflation inevitably hits the broader economy and asset prices explode, the rich instantly get richer. On the flip side, well, wage earners just get stuck with the resulting inflation. You effectively take a quiet pay cut, suddenly buying fewer groceries and less gas for the same amount of work without ever actually losing your job. Now, you might be wondering if there's a name for this. There actually is. The source points out an established economic concept for this dynamic called the Cantillon Effect. Basically, this theory states that whoever receives newly created money first, the banks, the elites, wins the game. Everyone else further down the chain just pays the price later on, quietly, through inflation. The text presents the Cantillon effect not as some random glitch in the matrix, but as a documented policy where the middle class essentially absorbs the financial blow for the benefit of those at the very top. All right, but printing money is only half of the equation here. Let's look at the second piece of this puzzle, the interest rate machine and debt cycles. The source argues that the second major tool used to quietly transfer wealth is the active manipulation of interest rates, which engineers a continuous, predictable boom and bust cycle. It breaks down like this. In phase one, we have a low-rate environment. Borrowing feels basically free, right? So everyday people happily take out loans, buy bigger homes, finance cars, and load up on debt. Then suddenly we hit phase two. The central bank jacks up the rates. This brutally shoves the economy into phase three, where all that debt becomes incredibly expensive overnight. Mortgages skyrocket, credit card debt crushes consumers, and smaller businesses start to collapse. The script argues this entire roller coaster is entirely by design. Booms engineered to make people feel rich so they borrow more, followed right on schedule by devastating busts. Which obviously raises a huge question. Who actually survives these wild cycles? Well, according to the material, the wealthy survive simply because they adapt their behavior to the environment. They know the game. In a low-rate environment, asset owners know it is prime time to acquire real assets. In a high-rate environment, they flip the script. It becomes time to pay down debt and protect what they've built. The text argues that the middle class, on the other hand, is repeatedly caught totally off guard, ending up crushed as wage earners, savers, or renters during the bust phase pretty much every single time. So, is there a way out? Let's talk about what they call the four-step escape plan. Having laid out this fairly grim macroeconomic picture, the source does pivot to a solution. It claims you absolutely can escape a system built against you, but only if you execute 4 very specific strategies. Step 1, you have to own inflation-beating assets. Step 2, reduce your dependency on a single paycheck, because honestly, relying on just one income source is a massive single point of failure. Step 3, understand those interest rate cycles we just unpacked, so you actually know when to buy and when to play defense. And step 4, diversify globally, recognizing that the US dollar isn't the only viable store of value out there. The script insists the system is built to keep you guessing, but following this framework is how you stop guessing and start actually planning. Let's drill down a bit into that very first step, because it is absolutely foundational to their whole thesis. The script explicitly lists 4 specific types of real assets you should own. real estate, stocks, commodities, and productive businesses. The core argument here is actually pretty simple. These specific, tangible assets generally rise in value when the dollar falls. Unlike holding paper cash, which is constantly losing its buying power thanks to the central bank's money printer, holding these real assets is presented as the ultimate shield against the machine. Ultimately, the source frames this whole issue as a massive mindset shift. It draws this really sharp contrast between what it calls the unaware saver and the informed investor. The text claims the middle class is essentially trained to react, usually in total panic whenever there are economic shifts. Meanwhile, the wealthy elite are taught to anticipate. They don't think the economy is broken at all. They believe it's working exactly as designed to transfer wealth from the patient to the impatient and from the unaware to the informed. The script notes you don't need a crystal ball to predict every single Federal Reserve decision. You just need to position yourself properly before the next big move happens. Which leaves us with this final, highly provocative thought posed by the source material. Will you choose to react or anticipate? The script concludes by asserting that, like it or not, central banks are going to keep printing money and interest rates are undeniably going to keep cycling up and down. That machinery is literally never going to stop, and let's face it, it's completely out of your control. But what is entirely in your control is your response to it. So, based on the arguments we've broken down in this explainer today, you really have to ask yourself, are you currently positioned to get crushed by the next turn of the cycle, or are you preparing to step out of the machine entirely?